Hi all, today is a little bit different. We are talking all about the lending side of home buying. Stay tuned and hear from a lender we just had a home buying seminar with to hear more details. Enjoy and make sure to text us and our team, and we are more than happy to help you find that next place to call home. Enjoy.
Gosh, hey everyone, Noah Rosen, CrossCountry Mortgage. I'm sure RESPA is going to be calling. So what's RESPA, by the way? RESPA is like the body that controls the mortgage business, and we're in charge. Also, I'm probably horrible to film because I'm moving all over the place, and I'm not supposed to be standing where the light is shining right on me, I guess.
See the tape on the floor.
Oh, I hit my mark, everyone. Oh, all right, I hit my other mark, everyone. All right, so what you guys have in front of you is Loanopoly. I like things to be fun and funny and all that. This sheet that you're looking at right here breaks down the process from start to finish, literally the home buying process, okay? Why do we break it down that way? Because the mortgage is just one part of the actual process in buying a home. And that's what the focus really is to buy a home. This is not just a purchase, this is where you're gonna live, or maybe you're investing and this is where you're gonna generate money long-term, in rentals and things like that. So the reason we show you all this is because, you can see, yes, there's investment stuff on here and whatnot. I'm sorry, not investment stuff, but steps that don't have anything to do with the mortgage itself, but are important to the entire process of you buying a home. And so what's most important to us, and I would hope for you, is that you're an educated home buyer, that even if you've done this before, that you understand the nuances associated with buying a home. So you have to start at square one. And the most important part of square one is getting pre-qualified. You don't want to go out and start looking for a home that you're not sure you qualify for. Let's say you qualify, but you love the home, but do you love the payment? Maybe you love the payment, but do you love the cash to close? What is cash to close? All these various different questions. I could go on and on and on for hours. I mean, everybody that works with me knows I'm a talker. God, if I was getting paid words per minute, I'd be a millionaire. But, what's that? Oh yeah, somebody get me on a timer. Somebody just throw something at me. But the point that I'm making is that I could unpack so many different things for you in this class, the time that we have together. But what I want to focus on the most is, one, questions that you guys have after I give you a little information on what a pre-qualification is. But most importantly on the front end here, I want you to understand what a mortgage pre-qualification is and why that's important to the whole process. So first and foremost, a mortgage pre-qualification is a preliminary check of your credit, your income, and your assets. That's literally all that it is. And frankly, there's no wrong answers on any of that, right? Even if we say you can't qualify right now, we're gonna tell you what you need to do to qualify, okay? And I can't speak for all lenders because I can only speak for my team, but our goal is not to just, again, sell you a mortgage. Our goal is to help you become a home buyer. And those are nice words, but in practicality, it does work. And so I always tell folks, if you're scared, you don't want to apply, you're worried, oh, my credit's this, or I don't make enough money, or I've got, not enough money sitting in the bank, or maybe you're like, I just don't know and I don't like doing new things. There's nothing scary about applying for a mortgage, right? Worst case scenario, you talk to somebody like me and you might have eardrum problems when you're done because I talked your ear off. So the long and short of it is, it's a check of your income, your credit, and your assets. Your income does not have to be high. It's all relative. Your assets don't have to be large. It's all relative to what you're looking to purchase. Your credit doesn't need to be perfect. There's programs for folks without great credit, just like there's programs for people with great credit. Our goal as licensed loan officers, and not just our goal as loan officers, but our goal as a company, our goal as a team, is to get more people qualified. So you have someone that you're talking with, me or someone like me, whose job it is to get you pre-qualified, okay? Once you're pre-qualified, if the qualification is done well, you should have no trouble getting final approved, okay? But there is that little bit of space and time in between getting your application done, getting that credit inquiry there, letting us analyze your credit, see how we can put together a program that works, and actually going under contract for a home, right? So what we always tell our customers, the most important thing is that once we've qualified you, we've looked at your credit, we've looked at your assets, we've looked at your income, that you're not making changes to that. And if you are, letting us know, right? because one of the most important parts of getting you from point A to point B is that the information on the front end was the same information on the back end. Because even though as a lender, we're looking, on the front end at the policies, we're running your information through an underwriting system that's telling us if you qualify for the loan, and effectively saying if everything on the front end is the same as it is on the back end, you should have no issues qualifying, right? If something changes, we want to know so we can pivot with you, okay? And you have to think of your lender like a part of the process. I think one of the things that the Larson team, the Joy team does really, really well is they make us a part of the team. And they make us a part of your home buying process. And one of the biggest factors in buying a home is deciding, once again, are you in love with that payment? Every time when you open your checkbook once a month to pay me, my company, do you love me, or are you like, oh gosh, that Noah, we didn't know what the payment was gonna be. So you need a lender you can partner with, right? But again, it all starts with that pre-qualification. So if you wanna take some notes, some things that you're gonna need, okay? When you're doing a pre-qualification. So first and foremost, you don't need perfect credit, but you should know where your credit's at. If you don't, of course, we're gonna pull your credit. But if you have questions before we pull your credit, ask them, right? Maybe you have a question about, well, I missed a payment 6 years ago. Well, we probably don't care. But if you're actively not paying a bill, doesn't mean we can't pull your credit, but maybe we'll tell you, hey, get this current first, right? Or maybe you have questions about your income. I work with a lot of folks who are newly graduated from college, or maybe they are they're a physician, but they're in their very beginning stages, just getting nested with a hospital or whatever. And they're saying, well, I got a lot of student loan debt, right? Or I just started my new job, and they have concerns. Talk to us. Those things are not roadblocks. We just need to know so that we can help you assess it, okay? But have a general idea of what your income is, right? It seems rudimentary, but it's not. If you don't think about it every day, you may not know how much you make every year. You just see it on your W-2, you know it's enough to live your life. Also, money in the bank. Your money should be in the bank, okay? Very important, cash. We love cash. I love cash. Who doesn't love cash? But we can't use cash, right? The federal government does not like that. So therefore, money needs to be in the bank. So some things you can do to prepare yourself to talk to a lender, hopefully us, but any lender, okay, is number one, understanding, am I current on my bills? If I'm not, am I getting myself current? If I am current on my bills, but maybe I haven't really done much with my credit and I don't know where it's at, let us know so we can help guide you there. Number two, knowing where your income is. Do I have the documentation to back up that income? Do I have pay stubs? Do I have my last 2 years of W-2s, right? That's something you might want to write down. I need 2 years of W-2s. If I don't have them, what did I do for the last 2 years? Maybe I was in college. Can I get my college transcripts, okay? If I am not yet employed but will be, because I have an offer letter for my new employment, do I have that available? Because we're gonna ask. And we really can't give you that official pre-approval until we have the documentation. So do yourself a favor and have it ready, okay? My money, is it in my name? Or is it in, this person's name, and now I need to get it into mine because, well, we have a joint bank account together, but, I don't want it in my name for whatever reason. The money should be in your name. We're gonna look back 2 months to make sure that that cash was yours. If it happened, if the money wasn't yours 3 months ago, we don't care. 60 days is the threshold though. So knowing that you have your assets, you know where they are, you know how much you have, you know how much you can comfortably budget, knowing where your income is coming from and how much, and then having a general idea about your credit is important. Again, these things seem, when you talk about them, it's like, oh, I would know that, right? But when you're on the phone or a meeting in person with a lender and they're sitting there asking you all these questions, sometimes it's not easy to remember something. So it's good to come prepared. So again, just to touch on that, last 2 years of W-2s or what you did for the last 2 years, okay? Most recent pay stub or offer letter for your employment, all right? And your most recent 60 days of bank or asset statements. And I say asset statements because you can generally use 401k money or retirement money. Little blurb, I'm not a financial advisor. I cannot give you, financial advice. Please consult your financial advisor. But generally speaking, you can take money out of a retirement account for the purchase of a home and in most cases not have to pay that 10% penalty that you would if you're under 59 and a half to withdraw retirement funds. But you'll pay income taxes on it in most cases. So that's something to consider, you know? But those are things we go over with you through the process, all right? So now you've gotten your documents. You're like, all right, I'm gonna call Noah, ring, 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 ring. Noah answers the phone. You're like, okay, I know how this is gonna go because he taught this class or this portion of it. He's gonna talk my ear off. So I've got 45 minutes set aside to talk to Noah, all right? Because I know I'm not getting off the phone for less than 45 minutes. But by the way, that's usually about how long it takes, okay? If you really wanna go through everything with your lender. And it's probably gonna be 2 or 3 calls, it should be, right? You're giving us business. This is important. This is the biggest purchase most people make in their lives. And you're borrowing a lot of money, but it's not bad debt because you have an asset that hopefully is appreciating. I mean, that's generally how the market goes, you know? So you should spend time doing it, but you're gonna need about 45 minutes to an hour to go through a full application. With us, you have the option of doing it online. If you'd like, with us, it comes back to our team. We'll set up a consult with you afterwards, but I'm old school. I like talking to you on the phone, all right? And my team's kind of like that as well. So long and short of it is set that time aside. And the questions we're gonna ask are super simple, right? What's your name? What's your date of birth? What's your social? Where do you work? How much money do you make? How long have you been there? How much money do you have? Where's it at? Are you getting a gift? Are you using retirement money? Are you? Well, I mean, we could. Nothing personal, but how tall are you? You know, what's your age? But well, I guess we know your age, you know? Yeah. No, wait, yeah, no, I'm like, I don't know, I'm gonna lie. I'm like, look at my driver's license, it's a lie. But the long and short of it is we're gonna ask some personal questions. So it's probably a good idea to be somewhere where you can answer personal questions. You know, you don't wanna be sitting in a McDonald's, you know, telling people your social security number, okay? But here's the thing, we're not gonna ask you for money, okay? We're not, so if you're concerned that someone is scamming you, if they ask you for all this personal information, but they're asking you for money first, you don't need to pay to make an application. A lot of companies that would charge you to make an application are doing so because they're concerned that you may not qualify and they're not really in it to win it. They're just in it to get a tick mark for an application. So just a word to the wise. Consumer, beware. Don't pay someone to do an application for you because you will pay us for 30 years on a mortgage, all right? Or as long as you have the mortgage, okay? And then this process, again, is that generally speaking, we're going to want to pull your credit. So be prepared to have your credit pulled, not because things need to be perfect. Once again, I keep touching on that because I think that's a roadblock for a lot of people saying, oh, I have to have this miraculous score. We will finance people with a 560 credit score. I mean, it's there, okay? Or we'll help you get to where you want to be to get better terms, better rates, okay? But be prepared to have your credit pulled because not all pre-qualifications are created equal. We don't even do pre-qualifications generally. We do pre-approvals. There is a big difference. A pre-qualification means you talk to someone, not like me, because I'm gonna tell you why it's not that great to do it this route, but you're telling me, I think my score is, I believe I earn around this much, I think I have this much debt, and I probably have this much in the bank. And then I'm gonna spit out a number. And I'm gonna say, here's a letter that says you can buy this. You're gonna go under contract, maybe pay for an appraisal, maybe pay your earnest money, pay for an inspection, and then find out maybe you don't actually qualify because of something that we didn't talk about. We generally don't do that. So if someone says pre-qualification, think twice. If they say pre-approval, that's what you want because we're actually looking at all those things. Again, garbage in, garbage out, but we try not to have garbage in. We want to have quality information in so that at the end, we're spitting out that quality pre-approval, which carries you then through to closing, okay? I know I'm not following Loanopoly, but this is more for your information, right? Because Loanopoly here, really, there's not that much about the loan. I mean, there is, yeah, you're applying, you're doing all these things, but this is the process once you go under contract, all right? Because once you go under contract to buy that home using that pre-approval that we gave you, the majority of the work at that juncture is done by the lender, right? Your realtor has gotten you from point A to point B. And by the way, I'm not just saying this because I'm here with a group of realtors and I don't want to get stoned on my way out, you know, but have a realtor. Do yourself a favor. We get so many for sale by owner contracts that fall apart because people didn't know the laws, they didn't know the rules, they did something they shouldn't have done accidentally. But I mean, I'm ignorant, I'm pretty blissful, but ignorance is not bliss when it comes to a legally binding contract, all right? So do yourself a favor, have a realtor. that's pretty much the long and short of a pre-approval, right? It's not really scary. It's not too invasive. I mean, outside of knowing everything about you financially, but it's good information for you to know. Now, the positive result is you get a pre-approval. You go out shopping. Your realtor takes that. It's usually good for 90 days. A credit report, by the way, is good for 120. A mortgage closing normally happens in 30 to 45 days or less. So we have to have an active credit report on file. And so because of that, it's no wonder that your pre-approval is good for 90 days so that we have 30 to 45 days to close without needing to hit your credit again, okay? But if your pre-approval expires, we'll renew it. But again, most people find a home, especially if you're with the Joy team, in a relatively short period of time. Or if you need more time, we'll be happy to wait with you. There's no pressure. Once you're in processing, once you've gotten under contract, you've talked to someone like me, we've locked in your mortgage terms, we've quoted you on the front end, we've told you a little bit or a lot about what you can expect, payment, rate, cash to close. At that point, you're then moved from the sales folks on the front end into your operations folks who are actually responsible for getting the loan closed, meaning they are collecting any additional documents. They're helping the underwriter. The underwriter, by the way, is the person approving the loan, right? There's lots of separation. Everybody works in a silo to prevent, various different things, fraud or, nepotism or whatever the case may be. But everybody works kind of in a silo, but they all work together. So your salesperson doesn't go away, but your underwriter's there, understanding what the policies and rules are, getting you final approved and collecting documentation from you through the operations team. The reason I'm giving you that information is partially because it's on the sheet, but to understand once again, the more accurate you are on the front end, the easier the process will be in the long run. Because again, we're going to be verifying everything that you put on that application, whether that's income, assets, information about your credit, various different nuances about your finances. So it's to your benefit to be as detailed with us as we possibly can on the front end, okay? And then obviously, once you get through processing, you get through underwriting, you have questions, it's happening, you reach out to your salesperson, they're toggling back and forth with underwriting. The way we manage our clients, the way we manage our business, and I think our partners, would agree with this, is we want to just be that one-stop shop. So you don't need to worry about, I have to talk to this person and this person and this person. My team, it's got a bunch of people on it, but when you're assigned to a portion of our team, you're talking to 2 or 3 people. Myself or someone like me, a processor, and usually a loan assistant that's in operations, okay, to carry you through from start to finish. So I'm gonna stop there, just in the interest of time. Am I doing okay on time?
Oh, you did good.
Am I doing okay on time? I can be good on time. I want you guys to ask questions. There's so much more that we can unpack and give you my contact. Go ahead. Okay.
So, is there a stigma between, say, a person wants to leave an employer,
Mm-hmm.
having that potential lull in income or like that uneasy, not knowing if the income is going to be exactly the same, more, potentially less? What does that look like?
It's a great question. So first and foremost, there are no things we can't overcome, especially with time. However, to answer the question directly, what an underwriter is looking for, what the mortgage is based on, is your historical ability to earn a certain amount of money so that you can into the future, pay the mortgage that you're taking out. Why is that important? For 2 very specific reasons. One, we want to make sure you can repay the mortgage, okay? Because even though you own the house, the mortgage is holding that home as collateral. 2, it is part of our legal fiduciary responsibility to you as a buyer to ensure that we are not putting you at a disadvantage with that payment, okay? So if you have historically worked at a certain employer for greater than 2 years or for 2 years, we're going to be able to say with confidence that person can earn a certain amount of money historically for X amount of years. We will be able to include things like commissions, bonuses, overtime, okay? But if someone's only been with an employer for, say, 2 months, or maybe they've left an employer and then they've had a gap, right? It's not something we can't overcome, but we may need to understand more, and we may need you to be at that employer for a little longer. So what I want you to take away from this isn't that you need to be an employer for 2 years. You don't, okay? If you're going to move employment and it's necessary while you're in the middle of trying to buy a home, make sure you're communicating that to your loan officer, Because as a perfect example, let's say you're working at company A where you're earning an hourly plus commission and overtime. And then you have no gap, but you move to company B where you have the same setup. In most cases, we cannot use overtime or commissions at company B. Why? Because they're two separate companies. We can say you're earning a certain amount of money hourly, and we can ask your employer to verify that you're going to work a certain amount of hours. Logic would say that if you're in the same industry, you can probably generate the same commissions and the same overtime, but we have no legal is not the right word. We have no historical proof that that company actually will do the same thing. So where we find a lot of that is especially folks that might be in like, I see a lot of that like in the trades, moving from company to company where a lot of the money is from overtime. Commissioned salespeople, of which I'm not technically, but I receive bonuses based on our company's performance. If I was to go to a different company, they would base it on my annual salary, not on my bonuses, at least for the last 2 years or the next 2 years. So that's an important question. The takeaway is gaps are okay, as long as they're less than 30 to 60 days. If there's more than that, it doesn't mean it's over. It just means we may have to address it or have you be at that employer for a little longer. You don't have to be an employer for 2 years, but you do have to be able to explain what's going on, and don't expect to be able to use variable income until you've been with an employer for 2 years. 1 year is on an exception if there's a really strong case, but usually 2 years. And by the way, guys, these are just general policies, okay? One thing our company does that I really, really like is we do not have our own overlays on policies. So if the general mortgage policy is you must be at an employer for 2 years, we're not going to say you need to be there for 3, okay? So it makes it a little easier, but good question. Any other questions? Cool.
Ooh, you did good.
Dang, did I do good? Nobody thought I could do it. No, anyways, thank you guys, seriously, honestly.
When you pull somebody's credit,
The world ends.
Does it bring your credit down slightly when the lender pulls it?
Beth and I have worked together before, you guys. This is Beth. She's got good questions. That is a very good question. So it does, right? That's why I'm saying be prepared to have your credit pulled. It doesn't make sense to contact a lender, right? If you're not ready to borrow. You don't know if you're ready to borrow until you're ready to let us see your credit worthiness. Your credit worthiness does not mean that it needs to be perfection. It means we just need to see your history of ability to repay. And if there have been troubles in the past, okay, we'll figure it out. Time fixes a lot of things. And I'm not talking a long period of time. I'm talking maybe months, maybe a year, but we can help you fix it. But yes, to Beth's point, in most cases, when your credit report is pulled, that hard inquiry remains on there and really has an impact for about 90 days. Again, 90 days, the pre-approval is good for 90 days, sometimes up to 120 days. And each credit report is different based on what else is going on in your finances. But you can probably expect a 5 to 10 point hit. But we would price you and qualify, price, by the way, rate, that price is another term for rate, and we would qualify you on the on the score before the pull. Okay, so the moral of that story, Ms. Hedke, is that don't go out and apply for 3 credit cards, go buy a car, go to 7 different banks applying for unsecured loans, and then come to your mortgage company. Don't do that after. Do it after you've bought the house, and then go hog wild on your credit for a while, okay? Actually, don't do any of those things. Yeah, don't do any of those things. But my point is, yes, we are going to use the score before the pull.
Not financial advice.
Yeah, this is why I'm in lending and not financial advising. I'm like, take it all out of the bank, go buy a house, you're fine. Yeah, hey.
You're filming.
Sure. Oh.
So this would be like you make your contract, you agree to a certain percent for like insurance, private, is that like the PMI?
The mortgage
right?
insurance.
Okay.
Mm-hmm.
So then that contract is for like the life of the loan, like how much you guys can charge like insurance for?
For sure. So just like you're signing a real estate contract to buy a house between you and your seller, that contract is good. Just like any contract, it has a start date and an end date, right? The start date is the date you sign the contract. The end date in the course of a a purchase contract is the date you close, the day the keys are yours and the keys are handed to you. With a mortgage, you're signing a contract. It has a start date which is the day you close, right? And then it carries you through until the mortgage is paid off, whether that's 30 years, 10 years, 15 years, 20 years, 25 years, 40 years, whatever it is. The terms of that contract are spelled out in your loan estimate, which you're receiving, and then at the very, very end, you're signing your mortgage agreement. That mortgage agreement outlines things like what your mortgage insurance will be and for how long. For those of you that don't know, in most cases, mortgage insurance is applied if you're putting less than 20% down on the home. Is mortgage insurance terribly expensive in most cases? No, okay? And that's something that your lender's gonna walk through with you, right? But the bottom line here, especially at CrossCountry, is we're gonna help walk you through what the payments are so you understand what those costs are. And yes, you're signing a contract where, again, in most cases, those terms are not variable unless you're signing up for something with variable terms, in which case your mortgage loan officer, state licensed or federally licensed or whatever, is going to go over those terms with you. Why is it important when I say licensed? Because that person has a fiduciary responsibility to act in your best interest, right? And so you want to make sure that you're working not only with a reputable company, but you're reading your disclosures, right? Because someone's going to explain things to you, but you need to see it on paper because you're agreeing to it, you're signing it. So to your point, yes, mortgage insurance, 20% down or less. Less than 20% down, you're probably going to have mortgage insurance. It's spelled out in your contract. It'll tell you how many years you can expect to pay that, because in most cases it falls off after a certain amount of time. And then, the contract explains when that is expected to fall off. So great question though. Anything else? All right.